before I get started again, any questions that you may have thought of during your break? You had a little time to cool off from seeing all those really awesome equations. Okay. CAPM. And in the world of finance and in investments, you don't even need to say the whole thing. You just say CAPM, and essentially anyone that works in that field will know what you're talking about. Anyone that's done research in that field, anyone that's studied that field, whether it's for college or graduate school or for their job. So chapter 7, key terms, CAPM. We'll talk about multi-factor models, and that's CAPM multi-factor models. I just didn't want to write the whole thing out again. We'll talk a little about arbitrage. That's another one, equity market risk premium. So here's what we're going to go through in these slides. The bulk of this is CAPM, a little bit on multi-factor models, and then I'll, at that point, try and talk a little bit about those academic papers. So what is CAPM? The capital asset pricing model. It is essentially a relationship where the price returns, the stock returns of a specific company's stock, or it could be an industry, an index of industry stock investments, has a relationship with the general market changes. And that's that market beta. You can see it right here on the screen in that equation. And this is called the risk premium. It's the return in excess of the risk-free rate. The risk premium, when someone says the equity market risk premium, it's the expected return of the general equity market in excess of the risk-free rate. On the end here, there's an error term. This is not a perfect relationship. There is error embedded in this relationship. In addition to that, there's also an alpha, and that's a firm-specific alpha. Now, there's a note on notation on here. In the Bodikina Marcus textbook, they use a capital R to denote excess returns, and they use a lowercase r to denote simple returns. So do keep that in mind. This is a model. Models need assumptions in order for them to work. And the big assumptions here, investors are rational, mean variance optimizers. So all that work I did in that prior session, the prior topic, we assume that all investors do that. And those of you that have taken glances at different social media platforms might call that into question. In this model, in the original model, the time horizon is a single period. So we're looking at 1 year. We invest our money today. We don't look at it for another year. Investors have homogeneous expectations, which means that they essentially have the same list of inputs. Everyone's on an even playing field. No one has different sets of information. No one uses different indicators. They all use the same everything. More assumptions about the market structure. And that second grouping there. All assets are publicly held and traded on public exchanges. The market is complete, meaning you can borrow and lend at the risk-free rate, and that transaction volumes don't impact prices. And of course, these simplifying assumptions, there are no taxes, there are no transaction costs. And hopefully this year it's become clear that even if your trades are commission-free does not mean there are no transaction costs. They're simply being borne elsewhere, and the impacts of those are simply a different form. So these are the assumptions that they make to make this model work, to actually for them to be able to make the math work out. Otherwise, it would become too complicated. And as you see, the calculations and work is already complicated enough. In what's called an equilibrium state, there's really no reason to hold anything but the market portfolio. It is on the efficient frontier and is the optimal risky portfolio because the risk-free rate has been adjusted to which the capital allocation line goes directly through the market portfolio. Remember the capital market line, that's where you go from the risk-free rate just through the market portfolio. In this equilibrium state, that sits on the efficient frontier, and that's the best point, the tangent point. The metrics around the price of risk, the risk aversion, the average risk aversion, level of risk aversion, that's the expected excess returns divided by the variance of returns, perfectly describes on average across the market of investors. That average is the same as the implied, it's called the hazard ratio, but the risk aversion ratio of the market portfolio. That's what that equation states. And also, there's no alpha. That's what that fourth bullet is. It's stated in a way that's a little bit nebulous, and so I added that last bullet on the point on this slide. In equilibrium, there's no alpha. There's no opportunity for additive excess returns. There's no opportunity to really beat the market necessarily. In this state, there's no reason to do anything but buy the index. Another name for this is called the mutual fund theorem. All investors would just invest in essentially the same index tracking mutual fund or mutual funds that all track the same index. This is the John Bogle world, the Vanguard world. Don't spend so much money looking for that needle, just buy the whole haystack. Save yourself a lot of cost. Those cost savings are better than any potential outperformance that you might find, because that finding it is fleeting. So if we look at the security market line, that's all in equilibrium. What happens when we're not in equilibrium? There's a potential that perhaps there are some mispricings in the short run, such that if we graph on the y-axis the return, expected return, and on the x-axis, instead of risk, we graph beta, we can actually a little bit more clearly see opportunities where a positive alpha could be earned. So what does that mean? This is from the textbook. obviously. Let's see, you have that market portfolio right there, denoted M, beta of 1. It has a perfectly correlated with itself. Then you have a stock over here who has a return of expected return of 17%, and its beta is 1.2. However, the implied expected return if beta is 1.2 is actually 15.6%. That means that there's an opportunity for a 1.3 percentage point alpha. Additive return. And so the idea of having these short run dislocations where the stock performance and its relative market beta are a little bit out of line with what they should be. If you can find stocks that have positive alpha and go long them, and then go find other stocks that have negative alpha and short them, well, that might be a good opportunity for a long-short portfolio. An interesting concept. That's the security market line. You have expected returns on the y-axis and the market beta on the x-axis. And it provides a glimpse at trying to find potential investments that have positive alpha. So here's one I modeled from one of the problems in the book. I'm going to have to look at it more carefully because I think that there's a typo in the way that they stated the problem, or at least it's a little bit confusing. But here's the securities market line. There's the market point, beta of 1, expected return of 12.5%, I think. Here's risky asset 1, here's risky asset 2. And you can see the first one has a return of 8.8%, but given its market beta, it should have a return of 11.2%. And here's one that has an expected return of 17%, but given its market beta, it probably should only have a return of 14%. So I would buy this security over here because the implied return, there's something going on here. I might short this one. That way, if the whole market goes down and the difference, the spreads here don't change, I'll be a little bit hedged. So these are extensions of the CAPM. And it all really hinges on that idea of, well, any short run dislocation should be short-lived, but in equilibrium in the natural state of the world, there are no alphas. Alpha is always 0. It does wrap it up into a nice, neat bow. Is this has just a quick, you can show hands. Can you raise hands? I can't remember. Do you have you come across CAPM before? Is there anyone who this is the first time that you've seen the capital asset pricing model? A few people, okay. The book goes through it, and I highly encourage you to at least skim through those parts and understand, really the basic forms of it. The higher the beta, the higher the systematic risk you are exposing yourself to in that stock. That stock will have higher volatility. The lower the beta, the lower systematic risk, the lower market risk you're exposing yourself to in that stock. And sometimes that might, that sounds like a good idea. But there are issues with this model. How much risk? How much risk is coming from that error term. And is the simplified model. Sorry, I lost my cursor again. Is the simplified model missing something? And so this model had been around for quite a while. And some researchers in the field of economics and finance and what's now called behavioral finance noticed a few things. And I'm going to go ahead and pull up one of those papers that I wanted to talk about. Bakanishok, Schleifer, and Vishny. And I posted this to the Canvas site so you can read it if you're interested in it. But they, are very courteous to, kind to include, which end of their spectrum is what they call glamour, and which end was value. And you can go through and look at, what are the data periods that they're looking at, and it goes here to between 1968 and 1989. They created portfolios. They have different formation periods. But this is book value of equity over market value of equity. It is the inverse of price to book. So a high book value of equity given the market price, that's over here. These are the top 10% of their universe that they're looking at. These are the value stocks. Over here, and the lowest 10% of book over market, those are high price to book. Those are what they call glamour. You have to pay a lot of money just to get $1 worth of equity, book value of equity. Look at the return distribution. This is the cumulative return over the 5-year period. 56%. That looks really nice. Except when you go all the way over here to the value end of the spectrum, 146%. I think SAAR has to do with market outperformance. They list it somewhere. Okay, let's do cash flow. Cash flow to price, I believe is what that is. So high cash flow per dollar that you had to pay. So in other words, low price over cash flow. Now over here, the top 10%, that would be value. The bottom 10%, that would be glamour. You have almost the same kind of distribution. Almost 3 times the amount of returns in that value bucket. Earnings yield, the inverse of price to earnings. So a high earnings yield would be value. That's a low price to earnings. And a low earnings yield would be a glamour or a growth. That's high price to earnings. And again, you see a very similar contour. There is some nonlinearity here. There's some, it goes up and then it comes down. So that just might be peculiarities. But consistently up here at the top end, much bigger outperformance versus the glamour stocks. Here's growth rate of sales, just simple growth rate of revenue. And this is the opposite. So low growth rate of revenue, the worst 10% in the way that they classify growth rate of sales. Highest 10%. It flips around. Value outperforms. And this is not the only paper that looked into some of these aspects. A lot of papers in the 80s and 90s really started to look at these concepts which came out of behavioral psychology and said, look, people aren't rational. People are normal. We don't calculate what's the minimum variance portfolio if we have these specific returns and risks and correlations available to us in the universe of investable assets. We don't think like that. As a result, the market does not, in reality, behave, definitely in the short term and sometimes in the long run, the way that these rational model, rational agent models work. And so these researchers said, look, the size of the company is an indicator of potential returns. The smaller the company size, the smaller the market cap, we notice that tends to actually lead to higher excess returns. Relative cash flows relative to price. Growth rate in revenues, book value of equity to market value of equity. And that's the way academics, flip those to what investors, practitioners do. They do book value over market value. They do earnings yield instead of price to earnings. So how did this impact the thinking of the traditionalist view, which was grounded in something, as we'll discuss next week, in the efficient markets hypothesis? How did they reconcile this? Well, Fama and French, who had written papers about efficient markets and CAPM, came out with a new paper and said, oh, well, small companies are inherently riskier. And so that's not a surprise that a smaller company would have a higher potential excess return, but they're also more risky. And when you have a high book to market value, that's the market pricing in all the risks inherent in that specific company. So of course it's a market pricing mechanism that indicates the inherent risk in that company's share prices. And so they introduced into their new three-factor CAPM model. They have the regular market risk premium, and they have what's called high minus low. So high book value to equity minus low book value to equity. It's essentially like, I think they take the two deciles, the highest decile and the lowest decile, and take the difference of the returns during that period. And so each company has their own beta exposure to that. Then they do the same thing for small minus big. What's the returns for the small, the lowest decile of market cap relative to the highest decile of market cap? Take the difference of that and say, okay, we have two new factors into our CAPM model. This three-factor CAPM model adequately adjusts the market pricing to reflect the information we're getting from this efficient market pricing mechanism. You can probably tell from the tone of my voice and the connotation of the words that I'm using that I don't buy it. And it's not to say that I'm smarter than them. These are very incredibly educated and highly intelligent researchers. Eugene Fama won the Nobel Prize. He did have to split it with two other people, one of which was Robert Shiller, who says efficient markets is phooey. To put it in a way that I won't get in trouble for recording. So they stuck with their guns. They stuck with their ideas that, oh, this is still efficient market pricing mechanisms. But the growth in the research and the academic research around, well, these models assume things about the way people behave, even professional investors behave, that are not accurate. And so when is it that those assumptions lead to problems? And there's lots of evidence to poke holes in the staid kind of traditionalist view of finance and economics, but they're not able to provide a counterpoint for consistent model and pricing mechanisms. As much as I can criticize things like the efficient markets hypothesis, things like the CAPM, there's no other model that can really do what those theories and those models do. A broker-dealer can't price forward rate agreements without making assumptions about efficient markets and no arbitrage pricing theory. Without making those assumptions, they wouldn't be able to price, well, what 3-month interest rate could I get a client that starts 9 months from now? They use market products to essentially price that in. All right, quickly on arbitrage pricing theory. Again, section 7.5, I believe, is the arbitrage pricing theory. And it's not really, it doesn't really present a lot of equations or models. It's a lot more conceptual kind of thinking. There are a few equations, but they're not things that you can read the text and get the point of it. So I'm looking at using diversification in a single index security market, where essentially it's explaining how the point of diversification is to reduce your weight of any single investment in your portfolio to the point where the idiosyncratic risk, the non-diversifiable risk from that investment is sufficiently small that your portfolio is essentially just investing in the market. And the whole idea around this arbitrage pricing theory, is that they're in equilibrium. Again, there is no opportunity for arbitrage profits. An arbitrage profit is one where you can make a riskless profit that is greater than the risk-free rate. And these opportunities typically don't present themselves very easily, especially in today's environment. And it's when a mispricing occurs across financial markets. So it could actually be across the actual cash market and the derivatives market, where they're tied to the same actual underlying security or company. They're actually very difficult to find and sometimes too difficult to execute for them to actually be worth it. But they do happen. But in this theory, in the long run, they do not happen. For a capital market, a financial market to be well functioning, that would essentially negate any possibility of arbitrage opportunities occurring. And in this framework, they have this multi-factor generalization of the arbitrage pricing theory. And just like in that CAPM factor model, they do the same thing, except rather than just having the market returns, the excess market returns, they introduce other factors, where it could be the example that they give, which is kind of interesting. They use what's the unanticipated changes in industrial production, or the unanticipated changes in the short-term interest rates. And so you can create, essentially using a CAPM style framework, but rather than using market returns, you can do it against other variables that are available in the public domain, or sometimes variables that you have to pay for, or that are internal to the company at which you work. But this has led to, in recent history, the concept of smart beta ETFs, which can, in fact, be long-short styles of investing, small minus big. Go long the small cap companies, the 1,000 or 500 smallest companies in the Russell index, and go short the 500 largest companies. Going long the low price to book, short the high price to book. Momentum. Which companies' stock prices have a track record over the last, 6 months, 12 months of producing positive excess returns. Go long those companies. And for a long short version, you would go short the companies that have had, over that same time period, negative, the lowest excess returns. There's momentum impacts in the marketplace. So these factors that have come about from this arbitrage pricing theory, which is pretty interesting, because they seem to be not aligned with that idea of efficient markets.